Good evening. This is Jeff Scott. It's June 18th, 2018, and this is my top-down review. And as I looked at the market this weekend to prepare for this, the one word that really popped up in my brain was divergent. And I'll show you some of the divergences that we're seeing. Interestingly, there's still a lot of stocks that look good. And I can tell you that I got saved by Amazon. I mean, I've got a significant Amazon position, and I either live or die by it sometimes. I usually offset my position with selling premium and sometimes with buying puts. And what happened on Friday was kind of interesting with the Whole Foods takeover, the initial dip pre-market, and then a roaring finish. So actually was pretty exciting. So let's take a look at the market and let's go ahead. Disclaimer, sessions for education purposes only. Any recommendations in the spirit of education, not investment advice. I'm a doctor, not a broker. I am independent. That means I have paid for every tool that I show you. I do not take money from any educator, advisor, software maker, tool maker, and anything I demonstrate or talk about or like, it's because I actually use it and find it valuable. Trading involves risk. You and you alone are responsible. Anything I recommend, as it says in the first line, should be considered purely for education. The other thing is I do from time to time talk about options. I recognize that according to the authorities, especially the Options Industry Council, trading options is risky. I recognize that if you don't know how to trade them, it's very risky. So I would refer you all to their excellent publications from the Options Council, and don't trade options unless you know what you're doing and willing to lose your premium. Not to spend much time here, but people ask me, what is my style? And I'm going to use, there's your answer on the top, the be your own guru style. I've been very fortunate over the years to get to know John Person. I spend a lot of time with him in his office. I've been to a lot of his training sessions. I bought his indicators. We've done some live education together from the podium. I do a lot of the things that he does, but I don't do everything. Up here is Ian Woodward. Ian took O'Neill's CanSlim and he made it electronic using HGSI software, but he also, I think, made it better. And then he taught me, I can't even imitate his voice because he's British, but Jeffrey, I'm not a guru. I teach you to be your own guru. And that really is the rule. You need to learn what works for you and then come together with your own style. I know many of you are pure CanSlimmers, and that's great. I found I could do better than pure CanSlim, but my foundation is CanSlim, and I think CanSlim is a great place to start. Morales and Katcher, for example, learned from O'Neill, one of the authors there, about CanSlim. They were money managers for him. And they've taken it and brought us things like pocket pivots, Bible gap ups. This is George Lee, my buddy, who I've also shared the podium with in trading seminars. And then up here on the right, Van Tharp, position size money management. And somebody who's been rather new to these discussions is Guy Cohen. And I really brought Guy up for some of the folks that watch this, want to learn, don't have the time, and don't really want to, I think it's a lower price bar to get in. He's got some good education, great education. He's got some good indicator, the OVI indicator. And he's got some relatively, sometimes I thought they were too simplistic, but they're very powerful trading tools on the web. And those are a couple of his sites. So what is my style? A little bit of each of them. Heavier on CanSlim and John, and a little bit of what I've learned from Guy as well. I own a lot of programs. I purposefully hide my desktop when I do these, if I remember, because I don't want to get bogged down and talk to you about individual programs. I'd rather talk to you about how I trade and what I'm looking at the market this coming week. You can see them listed here. And what, to me, Genesis is great to have. If you're a stock trader, it's far from optimal. It's far from mandatory. It's optional. It's a great program, and maybe it is the optimal program. But since you have to pay for it and pay for data, it's a lot less expensive to get free platforms and data from Thinkorswim or based upon current offerings at the time from TradeStation. HGSI, which I'll spend some time in, is my favorite tool for top-down investing. EdgeRater is a great tool for automating a lot of processes, and you'll see some of my scans from that in the PowerPoint. I like seasonality. It's dealer's choice on the programs. They all have benefits over, compared to each other. I do use all three of them listed there. I use seasonality often before I take a trade just to make sure that seasonality is not in my face. And I look for outlier stocks that have 10 out of 10, 15 out of 16 years, and big movement. But I won't take a stock that has good seasonality if the technicals are going against it. Here's highgrowthstock.com website. As I mentioned, I get nothing if you do something, except I like supporting the program, because what I do get is, and I should have some indicators added, or I don't know if it's an indicator or a field added to an update in July. When I want to have a change in the program or I have a request, it gets added to the work stream, which to me is very valuable. And I've been providing uncompensated, unofficial support for HGSI for a decade, hence my hgsidoc@gmail.com, which is an independent email, but kind of describes the HGSI component as well as the doc that I am. Free 30-day trial, so he doesn't even take a credit card, which is bizarre. And under investing strategies, where my arrowhead is, you'll see a number of webinars given by me and Ron Brown and others. Ron and I both use the program. I guess I could say we're both power users. We trade differently, which is kind of what's cool about the program. It's not about high growth stocks. It's about growth or value. It can be ETFs. It could be stocks. It could be shorts. It can be longs. Dividend investors. It's very customizable. And where I've tried, well, I won't say tried because that means it's intentional. Where I have taken what Ian taught me and added to it, Ron has added other things to his with the volume spread analysis. So we do things differently using the same program. Once again, where are we in this market? Futures right now are up a tad. They've had a little pop in the last 10, 15 minutes. I mean, in fact, right now the NASDAQ futures look like they'd open up a plus 20, which would be a big deal. Not sure why they popped up this way. Maybe it's because, I don't know if it's less likely that there was a terrorist in London or what, but I'm showing, according to CNBC, fair value about 18.5 on the NASDAQ futures, 6 on the S&P, and 44 on the Dow. I think if you ask me where I think we are, is you can take my arrowheads, bisect the top of this process, and then just keep doing that over and over again in a trading range. And I do think that although we're at all-time highs on a couple of the markets, I think we're at a position where I can't tell you if we're going up or we're going down. I have to be prepared for both. I have some thoughts, and obviously the indexes right now are trading up a little bit, but this is a market that, as you know, it goes one way one day the next. Certain stocks like the FANG stocks have been killed, yet we see new highs in the big caps. So I don't think it's an easy market to handicap. It's certainly not an easy market to trade, but you got to trade what you got, and you got to protect your base of capital, whatever you do. Why does it matter where we are? Because if you have uncertainty, and I think it's fair to say there is uncertainty, although when I look at, I'm looking right now at some of the indexes, we're in a major trend in the S&P 500, but that's not what the market feels like, and maybe it's because I'm too technology weighted, or at least I was too technology weighted. So when I get in uncertainty and indecision, to me it's raise cash, take smaller positions, and sell premium. And as I mentioned, again, some of my longer term positions, I may buy protection puts and then sell put spreads below that, call spreads above price, just to raise premium to offset the cost of the protective puts. So I like to start by looking at where the action was on Friday. I think you can see financials where my arrowhead are weak. Energy, interestingly, picked up some on Friday. Healthcare was mixed, including biotech. Consumer discretionary looks weak. Retail continues to look weak. Home builders were mixed, which is interesting, despite the fact that interest rates have stayed relatively low. They actually peaked right after rates rose, there were some shooting stars and some of the major players came back down. And as we'll talk about, some of them have earnings this week. And you can see down here that some of the foreign market ETFs have been roaring as well. Major markets tell the story. Here's the bull case. Look at the S&P futures, E-minis. Lower left, upper right, above the 17, green, 50, and the 200, everything pointing up. Hard to be bearish. Here's the NASDAQ, the NQ. Yes, it's been rough, and I'll show you somewhere else. It touched the 50-day moving average 5 times. Well, in the past, when it's pulled back to the 50-day moving average and paused a little bit, it's had a massive move after. So is that bearish or is that bullish? If I look at the Dow futures, not as high of a slope as the Dow, as the S&P rather, but again, setting a new closing high on Friday, or intraday high at least, I think closing high as well. The Russell had been lagging, had a brief spurt up as the FANG stocks were selling off, pulled back to the 17, so actually, from the indices perspective, in a shallower pullback right now than the NQs. The VIX, every day it seems to trade up a little bit and then close back down near the lows of the day. It's still higher than it was a month ago, but if you look at it over the last several months, it's clearly at the bottom of the range. And the dollar still weak, and right now the dollar looks like it might be up a little bit after hours. I'd have to go look closer since it's a little bit of ways away from me. If I look at the weekly, here's even a more bullish case. Even that NASDAQ pullback on the weekly looks fairly gentle. So lots to not like about the market, especially if you're heavy in FANG. If you miss your earnings, there's been some volatility of late. But all that said, at least on the E-minis, the NASDAQ, the YM, and the Russell, we're much closer to the highs than the lows of this on the charts, and we're near highs in all the indexes. So hard to be very bearish, except there's lots of underlying things which we'll talk about which are more concerning. Daily, weekly, I like to overlay these so I could see 3 time frames, daily, weekly, monthly, E-minis, NASDAQs, Russells, NYSE, and the Dow futures. Again, the one that looks the worst here on the daily is the NASDAQ. The 50-day moving average is right here on support, so you don't see it here. When we look at the weeklies, they look much better, although several of them on weekly sell signals right now. Many of them, the NYSE, the Russell, the NASDAQ, and the E-mini. So pretty much they're all across the board, including the Dow, are on weekly sell signals in Genesis. They're all on monthly buy signals, and you could see from a monthly perspective how we're in a very long run here. Now, certain things to me don't make any sense. The Fed raised rates, yet both the yield on the 10-year and the 30-year fell. Now, I thought if the Fed would raise rates, then the 10 and 30-year yields on the bonds would go up and the price of bonds would drop. So I actually talked to my daughter's boyfriend, who's a pretty smart guy, and he thought that the reason for this was either there is or there's an expectation of an expansion of the money pool, and that could keep the rates down. Bottom line is, I'm concerned that is it not the economy, and is there a weakness that we don't see, which does go in the face of the Fed raising rates. So there's a lot of unknown there. Bottom line is falling rates are good for REITs, MLPs, utilities, dividend payers, and home builders. The ones on the top, except for home builders, look relatively strong this weekend. We'll talk more about that later. Interesting here, see if you can see it. The yellow is the S&P 500, and the white line is the AD, and the left on the Russell, and on the right, on the 2,000 on the right, the 1,000. So the small mid caps and the large caps. What was kind of interesting here is the small caps sold off. The AD fell down with the market, but the AD line on the large caps, the Russell 1000, continues to push higher. If the AD line is leading price, then that I think would have to be considered a bullish thing, but it only represents the larger caps, not the smaller caps. Breadth I look at the percentage of stocks on the left above the 200-day moving average, above the 40-day moving average on the right. It's hard to see, so I have little arrowheads here that show you where we're at. We're kind of in the middle, so I would say breadth here is neutral. I look at the 3-month new high, new low. This is where it was last week, and here's where we are today. When I get up here, I know the market's going to pause or pull back. We're nowhere close to that, so I would take that off the board and put that at neutral as well. So my breadth indicators so far don't show horrible divergence in breadth, but they do show, and they actually fall out right in the middle of the range of breadth. So again, supporting the idea that maybe this market is not done going up, and it does not have to go down because it's gone up so much. The McClellan will be interesting to see on the daily and the weekly. I guess it's the same, it shouldn't matter, but whether the summation index, the oscillator rather, will have a zero line reject and bump off the flat line. It's just above it today. New highs. This is a worrisome component here where, especially we break below the zero line, we can't get above the zero line in the summation index. So this goes in the breadth category that, we're getting higher highs on the S&P. This is, I guess, the McClellan's on the NYSE. So even though the general market's going higher, we're not having expansion of stocks that are participating. In fact, this suggests that the breadth of winners is getting smaller. Current buckets. On the left, you show where we are. So just for a quick review, I take all the stocks in the S&P 1500. I run them through a filter in EdgeRater, and it looks at what your percent B is, and then looks at 0 to 10, 10 to 20 for percentile between 0 and 100 of the Bollinger Bands. It adds a less than 0 bucket for stocks below the Bollinger Band and a greater than 1 for those above. Last week, we had over 20% were above the Bollinger Band, 74% of stocks above the midline of their Bollinger Bands. And I don't necessarily see a big correction when in a bull market when we get a little bit, I call that shifted to the right or a little bit aggressive exuberance. But typically we get a pause. And if you look at it today, you can see the number of stocks above the Bollinger Bands has dropped below 6%. And really hardly any different than those below the Bollinger Bands, and we're closer to midline percent of stocks above or below the midline in the S&P 1500 Bollinger Bands. So again, another argument that we are not overbought nor are we oversold. Here's the bearish argument. I've lined up here a Hindenburg as measured on the NASDAQ, the NYSE, and the Russell 3000. One of the caveats is the calculation for above the moving average, a rising moving average, is probably not exactly perfect in EdgeRater. And so I put that caveat in. I believe the official diagnosis is the moving average today is higher than it was 50 days ago. And so that interpretation could put some difference in my results versus your results. But I use basically I use the moving average rising or falling in the spiders to calculate this. And I may think about if there's a better way. Bottom line is, back on the 31st, we had that first concerning sign when both the NASDAQ and the New York Stock Exchange, and this doesn't happen often, I think it's been talked about by many others. By my calculations, it also happened in early May when we threw a Hindi on both the NYSE and the NASDAQ. Around May, that was the only one we saw until later in the month when we saw two. We have not seen one since. However, if you see the red 3, that means 3 out of the 4 characteristics were met on each of the 3 indexes, and the 1 out of the 4 that wasn't hitting was the one that I'm not certain I measured correctly. So the ones that we know are correctly, looking at McClellan, looking at new highs less than twice the new lows, and both new highs and new lows greater than 2.2%. We fired 3 out of the 4 potential options. It's very interesting to see what's going to happen. That suggests a shocker alert that there's still a lot of turbulence in the market, despite the fact that the futures just had another pop up. I really wonder if this has something to do with what's going on in London. Maybe it's not a terrorist attack. Market tone equals chop. I just look at this third thing here. The only thing that's red is I think it's the NASDAQ 100. Everything else is yellow, green, and red. When I don't get consistent, this is very bullish. This is choppy to bearish. This is chop. It's not bullish, it's not bearish, so we are in chop from a market tone. And from a sector strength, again, looking at the third series down, the winners in green are materials, financials, and healthcare. The losers in red are technology and staples. And as you could see, kind of choppy from a sector perspective as well. I like to look at the canaries in the coal mine. Actually, this is what was touching the 50. I stand corrected. Although I think the NASDAQ may have as well. My canaries in the coal mine is something that Ian taught us, is I take some of the leaders. In this case, it's Apple, Baidu, Facebook, Netflix, Google, Priceline, and I create an artificial index of these, and I use these to give me sort of a clue as to what the overall market is doing. And I know that often they'll sell off before the general market does. Well, they sold off back here 6 or 7 trading days ago. The interesting thing is the blue is the 50-day moving average, and they touched it 1, 2, 3, 4, 5, 6 days in a row, and they closed Friday sitting on the 50. When you think about the stocks I like to buy stocks that are in an uptrend that pull back to the 50, which we call in Ian's world free parking, and we buy it with momentum off of free parking. Well, I can't be overly bearish, except it's a 50-50 call. You got a doji there sitting on the 50. Do we break above it with a high close doji and go on to new highs, or do we continue to break down and try and visit that 200-day moving average, which we have done it multiple times in the past, so we'll see. It's a long ways away. So I would say I showed you a lot of indecision, maybe a little nervousness on the Hindi, and maybe less nervous on some of the other breadth indicators, because I don't see a market that is clearly going down this week. I mean, I think there's high risk, and we'll talk more about that. Know your news and earnings dates. As I looked at this, I mean, on Friday we've got a bunch of things, on Thursday rather, jobless claims, natural gas. We got some Treasury announcements. We've got a lot of Fed speak. Those are the black words. But, you know, if I look at which are the big ones for the week, PMI and new homes on Friday, jobless on Thursday. You know, the oil, petroleum will move that market on Wednesday. All in all, not the craziest week. I didn't see Oracle's results. They may have come out already, but Adobe, FedEx, and Lennar are all due on Tuesday. Those could certainly be market making, and obviously you may own some of these large stocks as well. As I put down here, it's a judgment call to hold stocks over earnings dates. Sometimes you win, sometimes you lose, but let you lose or win because you made an educated decision. It's bad judgment to not know when your stock's earnings date is scheduled, and by no means is that an exhaustive list including everything. Market thoughts. Big caps are at new highs while the NASDAQ and small caps pull back to support. Market painful, but still not broken yet. Yet there's still time for caution. Amazon jumps Friday on Whole Food Market takeover news. I suspect this, based upon what I'm reading and my interpretation, this should lead to upgrades, and we should see them Monday morning. This could be a catalyst to pull up the FANG stocks, maybe, question mark. Yield divergences as Fed raises while rates on 10 and 30-year fall. Talk of unwinding of purchases don't appear to rattle the bonds. Does this tell us something about the economy? And, you know, if you see a bear market, and some people might think we're due a bear market, well, the one thing I can guarantee you, and I don't make many guarantees, is that someday we'll have another bear market. You would think that the economy would roll over, deteriorate, and lead the bear market. So right now the economy hasn't rolled over yet, so we'll see. Healthcare looks interesting as specialty pharma, large pharma, medical devices, health insurers, and even biotech are firming. But beware, we're promised an executive order on drug prices this week, so that could be a cloud. And in the past with Martin Scarelli and on the Hillary presidential campaign trail, every time she spoke bad about pharma and bio, LABU dropped 5 or 7%. This week, as I looked at stocks on my buy and sell list, yield definitely appeared to matter. Utilities, REITs, MLPs, and low rate may also favor housing-related and mortgage-related stocks, although they did give back some at the end of the week. So let's go on to our top-down review, and I'm going to pause it for a second and rejoin you shortly. All right, I went over to TradeStation, and I had an error, so I have to restart it. So I'm going to jump into HGSI and see what TradeStation, when it boots up, my indicators will work. For some reason, I did an upgrade on TradeStation. That was probably a mistake. And every time I start it, it looks for my indicators all over again, some of the App Store indicators. So hopefully that won't be a persistent problem. So in HGSI, I go down to user groups. I go to the Woodward and Brown groups, and I go to Major Markets Plus, and I want to get a sense of the markets, what's working, what's not working. I use my top-down analysis view. I rank by raw combo. And what this is telling me is what's working right now as an end-of-day Friday. It tells me which things from a 5-day, sure, it's 1 day mostly, 5-day secondary, and 3 weeks third on a price and volume, which are the best movers. You know the market's not horrible when the Dow and the NYSE, utilities, and transports are the top 4, S&P 100 and 500 number 8 and 9. Compare that to gold miners, silver, the VIX. The problem is right here, is down at the bottom are the S&P 600 small caps and the NASDAQ composite, semiconductors, Russell, and the NASDAQ 100. So there's a divergent market where these guys up top are still strong, yet the semiconductors and technology stocks, as you all know, are laggards right now. If we look at some of the individual charts, and let's open up the S&P 500 to start with, I like to look at a few things. Let me go into my view here. So a couple different things. This is a Hindi, and this is the one that must have fired on the 31st, I guess. Let's see if I can make this fit the screen. Is that that was the one on the 4th. So interestingly, using our tools in HGSI, I did not fire on the 31st. And the Hindi is going to be calculated on the NYSE regardless. There are some challenges as HGSI changed the vendor for the NYSE. So that's why I've been doing an edge rater. Now, interestingly, if I do go back to 2007 and 8, you'll see plenty of Hindis fired at the initial top in the summertime, and then the market came back to test the highs, and then you could see the market rolled over, and again, a series of Hindenburgs. You don't see many patches like that. It's when I see a spurious single Hindenburg, I don't pay much attention to it, and thus I noted this one, but did not change everything that I do. Let's see. Just for whatever reason, John's indicators were not working when I rebooted this computer, so I may not go through my TradeStation analysis. Now, a lot of people ask me when I look at TradeStation, why aren't I talking about my bongo? Because I will show you that. In TradeStation, I actually do have an indicator sitting down on the bottom, which is one of the most important things to me that I do. And that indicator is a 3 time frame bongo, daily, weekly, and monthly. The bongo is something that I created with some of my colleagues probably a decade ago, and it remains my overall buy-sell signal for the market. I pay most attention to the weekly bongo, and when the weekly bongo is in a sell signal, there's a good chance I don't want to be long the market when that happens. Close this down. All right. So up here, this green bar is the weekly bongo. You can see on the S&P 500 it's green. When the daily bongo goes red, that is giving me a hint that the market's in a shallow or maybe get deeper pullback. So S&P lower left, upper right, You can see several times a visit of the 50. We're nowhere close to that. We're sitting on the 17 and the 8. I can't say anything but bullish on that chart. I look at the Dow Jones Industrial, ditto, even better, closing at an all-time high, I believe, and look at the volume that came in, but it was options expiration. That may be that reason. If I go down and I look at the NASDAQ, you'll see a different picture, and you see a market, and these are my markings from before where I basically talked about what's going to happen after this sell-off, and I sort of projected that we were going to bounce around, but I talked about would we bounce around and break to the upside, would we come down and visit the 200. I called out the importance of the 50-day moving average, and if I clear those off, we can see that we have not really penetrated the 200, and we're sort of doing that bouncing around here. So it'll be interesting to see what happens if and when the NASDAQ declares itself. I will point out it's still in a weekly bongo green. And then lastly, the weak sister has been the Russell 2000, and it was in a new uptrend here, and it rolled back over this week as well. And you could see it's in a weekly and daily bongo green. So I look at those indexes. It's hard for me to be depressed and think that this market's going down, although it does feel much more volatile than it's been. And notice how the Russell really has been flat now for basically since middle of December. If I look at the dollar, somewhere around here. Nope, that's not the dollar, but it's right above the dollar. All right. You can see the dollar's had a pretty substantial sell-off. Back here it had dropped, ending in, from beginning of the year, it had dropped down to the 200. It bounced around the 200. Often the major moving averages will be support. Once you broke through, they become resistance. And the dollar, I won't say it's in free fall, it's kind of going sideways here, but the dollar's clearly weak. Speaking of weak, and been weak for a long time, we can look at the volatility index near the bottom, and you could see it may get above where it's closed the last couple of weeks, but it's low. And if I put this on a weekly chart, you can get the sense that the VIX doesn't get this low very often. If I go on a monthly chart, you can see the VIX doesn't get this low very often. That's going back to early in 02. So the VIX is extremely low. I'm not a believer. I know George and I have discussions about this. I don't believe that a low VIX by itself tells me anything. I think a low VIX by itself just tells me that there's not much volatility. It's when the VIX starts to rise that I know that I'm in trouble if I'm long and that my longs will suffer. It's when the VIX falls is when the market rallies. And you could see on a daily basis we've gotten threats to move up, and then we close down below where we opened the last several days. Hence, you get that market sell-off in the morning, and then the market ends up closing back towards where it opened at the end of the eve. You'll also notice, consistent with the long-term downtrend, that the VIX is mostly green. I know many folks, myself included, have been known to try and chase this, but the only way if you look at something like the VXX, which is a tradable instrument, it's hard to believe, and let me just make it even worse. It's hard to believe that you can make money to the long side on this instrument. That's 30,000 because of all the reverse splits, and it's currently trades at 13. There's the SVXY, which goes the other way. It goes up when the VIX drops, and this one is a lot more fun for me to trade. It moves both ways, and I've known to short it when I think the market is at risk and the VIX is going to pop. But wouldn't you have been nice just to be long this and forget about it? If the dollar's weak, you might expect gold to be strong. Interestingly, gold is not strong right now. Let me get back to a daily. It's fallen back towards the complex here of the moving averages. The bongo's still green. I don't really have a call on gold. If I look at gold miners, they're actually weaker than gold. failed at the 200. How many times does it have to fail? See, support on the way down turned into resistance on the way up. And then silver sitting down here as well. So perhaps it's the silver and the silver miners that are pulling the combined miners index down. So that's where I start my analysis. Let's see if I can do the trade station is going to work for me or not. Yeah, sometimes I notice that John's indicators, it's not John's indicators issue because some of them are probably working, but I'm looking for, yeah, I'd have to reboot the machine or at least reboot TradeStation. So we turn it off. And we're going to do this without TradeStation today, which is not a problem. I want it to be short anyways. The next thing I do is I go down to 07. These are the industry groups. And I'm kind of curious, how are these industry groups lining up for where's the movement, the bullish versus the bears? I can see that on just the same analysis, 1 day more than 5 days more than 3 weeks, short-term insurance brokers, medical devices, investment managers, utility networks are leading. But I don't really care about 5 days. I care about the last couple of days. So to me, momentum is price and volume. So long ago, we started using the 2-day force to predict momentum. 2-day force would be today's price minus yesterday's price times today's volume plotted. And then I take a 2-day exponential average of that. And I use that to rank which stocks are moving. There's some flaws to that, and I'm hoping to see a different equation formula come out shortly. And when it does, I'll explain to you the flaws and how I'm doing it differently. Everybody will get access to what I have, so when I get it, you'll get it. 2-day force is a fast moving. These are the things that are moving up quickly right now. And we have 41. Moving down quickly, we have 9. Beverages. Interestingly, I saw a lot of strength in REITs, but I suspect it's in the type of REITs that are showing strength. Apparel, entertainment, lodging, home builders, even with interest rates falling, were the weaker groups. And I'm just curious because I did see some good REITs. So REITs has 55 to the downside and 75 to the upside. So I don't then feel bad that I thought REITs were strong because when I looked at the top-down review, REITs were strong. So, if I wasn't worried about time, I might look at the REITs to the downside versus the upside and think about REITs. You'll have REITs that are public storage, like the box that I pay $200 a month, garage to store my baseball cards like an idiot. Anybody wants to buy a good deal on baseball cards, you know how to find me. It would make my wife very happy. REITs that are data centers are strong. REITs that are shopping centers were strong, but they've been weak for a long time, and I wonder about them. Gaming and entertainment REITs have been strong. Healthcare REITs have been strong. So if I look at a 5-day window, I look at a little longer momentum, 41 to the upside, and over a little bit longer period of time, 46 to the downside. I would say my gestalt on just those numbers is it's a little bit to the bullish side, but pretty darn neutral. Because the down was only 9 on the short term versus 41, but the longer term are pretty equal up and down. So now I've ranked these by force, and I could see the groups that I want to be playing in. So first thing that I noticed when I looked at that was healthcare, 1, 2, 3, 4, 5, 6, 7, 8. That 8 of the 41 leading groups, and I think it was, let's see quickly, 1, 2, 3, 4, and 5 of the 12 are healthcare related. That suggests to me that there's some underlying strength in XLV, and we did see that on the Edge Rater view where that was one of the ones that turned green. Despite the oil pricing story, midstream, which is I think a dividend play, refiners which may benefit from cheap oil, Integrateds, which have refining and exploration and other, and transmission. Services make the list. I don't see oil exploration here. All right. So energy, surprisingly on the services side, shows some strength as well. Let's take a look then at some of these. Midstream oil and gas. I'll tell you right now, a lot of ugly charts with big dividends showing reversals. Here's one okay. So let me walk you through my messy chart, which to me is a very easy chart. Remember, red is bad, green and blue are good. Up at the top are some technical fundamentals. If I scan through, I can see additional fundamentals. And if I don't know what this stock does, I can even get a little bit of a background there. These are the next 2 quarters for earnings per share growth. This is the last 8 rather, and they're compared to the quarter 4 quarters ago. So 41 cents was compared to 40, 2.75 billion was compared to 1.77 billion. The top bar here is the Hindenburg. We're not going to worry about it because we know that we're okay there right now. This is the weekly bongo. That's red. That says these have been in a sell mode. We have a daily bongo that's green, so this could just be a retracement in a downtrend. Distribution is the third one, which is pink, which is distribution. The 2 and the 13-day force are up. That's interesting. This is the high jump bar. When it's up at the top, I know that my markets are usually extended and may pull back. This is a red candle low. This green line is a green candle high. The next 3 are technical indicators. I have Bible gap ups, which this one has not had. The yellow is a squeeze. The green is a mobile breakout. The red is a mobile breakdown. On the chart, I use 4 moving averages. I use an 8 exponential in magenta. I use simple 17, simple 200, and simple 50 and simple 200. 17 green, 50 blue, 200 red. The dots here are the Wells Wilder PSAR system. It's automated using the standard values within HGSI. This gray line is the industry group. Down here we have pocket pivots. Remember, red is bad, pink is bad, blue and green are good. Here is on balance volume and a moving average. The red here is calculated on the NYSE or the NASDAQ, not on the instrument, and that is a phoenix. That's usually when the market itself is rolling over, and the eureka is when the market's about to turn up, again calculated on the market, not on the specific group or stock. And down below are the kahunas. So I don't like the technicals by any means. It does look like it's bottomed here. It's moved off with a kahuna. It's in a downtrend. It pays a 4.8% dividend. Williams Corporation, not as deep below the 200, but still in a weekly bongo down. Below the 200, pays a 4.1. Kinder Morgan pays a 2.6. One OK Partners pays a 6.3. One that I do have some is ETE, which I keep for a 6.9% dividend. Doesn't seem to move much from a stock price. So this group may have made it to the top. It's not because they've got beautiful chart patterns. I think it's purely because they pay a big dividend. The next group is going to be semiconductor devices. So despite all the tech wreck that we hear on CNBC constantly, this made it to number 2. And some of these have had some nice round trips. This one's breaking out Impinji. Take a look at this one. PI, big move on Friday. Bible gap up, mobile breakout from a squeeze. Everything's green. A kahuna broke up off of the 17-day moving average. It's got earnings coming in. Small revenue stock, so it's not a big stock. Big price though. Market cap's only 1.5 billion, so it's not that big. I can't chase this. It's gone too far. Notice the high jump bar here is pegged to the top, which means it's as extended as it's ever been. There are ways to trade Bible gap ups, but the bottom looks like it's at about, let's see, it opened at 49. It closed at 55. So if I put my stop below the open, I'm 12% away from where my buy stop would be. That's too far. I would pass. The next one down is Hymax. had a big move off of a congestion and moving averages. It's kind of oscillating sideways, not my favorite stock. AAOI, I think this one, I have some of this. I think this is one I may add to my position. It looks like an optimal buy point if it trades higher, takes out Friday's high. Why do I say that? Weekly bongos maintained, it held at the 50, and we could see multiple times in the fast that the 50-day moving average has been a takeoff zone. I would rather have seen a kahuna or pocket pivot or some momentum coming in here, and it would be totally okay to wait for it, but I would add AAOI to your watch list. Coherent, ditto, in every possible way, except it had its kahuna, a high close doji off of Thursday's doji. Everything is green. The problem with Coherent is it's a $240 stock. That said, just out of curiosity, how much are calls? My target would be probably about 270. It's at 240. So I could go into Thinkorswim COHR and look at, let's look at an August table, and a $240 call is absurd. It's $19. But you don't have to keep it to conclusion. So what would be a spread? So it probably cost me about $2.50 to buy a 240 call, 289, and sell a 250. It'll cost me less than that. That could be one trade. Maybe I could buy a 240 call, and let's see. Let's just pretend I'm not paying $5 for that. 220, and let's say I'm going to sell a 260 call. So I could, for $7.60, control 100 shares. So it would cost me in the trade $760. I would control 100 shares of Coherent, and I would get called out at 260. So my upside would be 20. My cost would be 760. So almost a 3-to-1. I do think Coherent is a great buy point. I think those who know me know that what I would more likely do is one of these. I can't build it fully in Thinkorswim, so let's see how close I can get. I would do a synthetic, and I may actually do this trade, and then we'll talk about it next week. So somewhere around $1, I can buy a 240 August call and sell a 240 August put. And then what I would do is, I don't know if they'll let me do this. I don't usually build this in this program. Advanced order. Okay. And then the second trade that I would do is I would look and maybe sell a 240 minus 10, a 235 put, or 230 put. So let's get here. So if I can sell an August 230 put, I like this a lot. I only want to do it once though. All right, so notice this. For $11, I can sell, but I don't need to sell it, unfortunately. I need to buy it. That's the problem. So I can buy for $14. That doesn't seem right. 241, 230 put. So it's going to cost me $11, not $14.80. So what I could do, and I don't like this trade, I can tell you that already. I often do these synthetics where I do a trade to start with that is a buying and selling a put and call, buying a call and selling a put at the same strike price. That's called a synthetic. And when I do that, I get the complete return of buying the stock, but basically at the 240 strike price to do a synthetic position, covered stock, at the 240 strike, it's going to cost me about a dollar. All right, I'm going to get it, not cost me, I'm going to get paid a dollar. So what that is doing for me is I can buy a lot of calls when I get paid every time I buy this position. The problem is if the stock trades down, I have the same risk that if I own the stock, which means if it trades down, I lose money. So, but that's okay because I'm not putting out an investment, so I'm getting the stock, I'm carrying the same risk and the same benefit as owning the stock at a lower price. And then I'll often buy a put underneath the put that I sold to protect me from a disaster. So if I go back here, I might look at down here to buy a put, and then I'd buy a put and a call at this level here, and then as long as the stock goes up, I'll participate in 100% of the gain, and I'll have a built-in stop with my put if the stock moves against me. I didn't do a good job of that. I apologize. I'll make it up to you next week. But if you've been watching this before, you know I call that my chicken shit option play. And you know what? I feel bad I didn't do a good job of that, so let me just show you what I'm talking about. Where I was at, let's see if I'm going to get data. What we were talking about was coherent. And I was talking that I might be interested. Let me close that window. I don't know what that window's doing. Oh, there it is. Close that. That I was interested in coherent and that I'd want to buy it if it traded above the close, and that I'd probably want to put my stop down here, risking about 10 bucks. Maybe even bring it down here to where the gap was. Now, there are a lot of trades I could take. I'm going to put my spread selector here, and I'm looking at coherent. I'm bullish, so I could look at a bull call spread, a bull put spread. I could look at a long call. I could look at long stock. Short a put. I can look at a synthetic. I'm going to look at an August expiration and my starting price and my spreads. I'm going to only do one strike. Okay. So, hold on one sec, my dog is looking. All right, I'm back. Sorry about that. People who know me know I'm pretty attached to my dog, and sometimes it amazes me the nonverbal communication, how good it is between my dog and I. I think sometimes my dog and I understand each other better than I do my wife. But I think others with dogs, probably wives versus their husbands as well, probably feel the same thing. So here's the different trades I could look at. This would be that $5 spread here. That's probably not enough for me to do, but that would be a bull call spread where I was hope the stock would go up, where I would put out $220. I could make $280. I think that's a very high risk trade win. My risk and my benefit are well defined. I don't like that because it's probably high likelihood of occurring, of winning, but the win and the loss are it's too close. A bull put spread. If the stock goes up, my puts expire worthless. The one I sold is more money than the one I bought back. And so the difference between these two trades is actually interesting. My profitability is not that much different, but instead of putting out $220, I'm getting paid $230. The most I can risk is the $5 width of the spread minus the $230 or $270. So a bull call or a bull put spread, I collect money versus put money out. My risks are comparable. So if you look at these, you'll see a curve, I hope, and that basically, as the stock moves up, I make more money. Here's where I am today. As it moves down, I lose money, but my gain or my risk are capped. That's it. I don't have any more. That was it. That was the last treat. We're done. You notice that the break-even point is to the right of the current price, and that's because I had to pay money to get that spread. While the bull put spread, similar looking pattern, except I make money until the stock drops more than the amount of money I collected, $2.30. I find that these to be safe trades. You know your risk going in, and you can collect premium or pay out a little bit. If I was to buy the stock, well, that's great, except you'd have to put out $24,000 to buy 100 shares. And this is what a P&L curve looks like with the stock. Here's the price today. This small dashes here is the break even. As the stock moves up, I make money in green. As it moves down, I lose money. Remember that pattern. So my break even is the price that I bought the stock for. My maximum profit's infinity. I don't know how high the stock's going to go. And my maximum downside, I can go to zero, which would be, in this case, $241 or $24,100 on 100 shares. So the benefit of buying the stock is unlimited gains. The risk is I could lose everything. I have to have margin to afford this. I can put my stops in, obviously, to limit my loss, but they don't protect me against the gap. But I get the upside, but I still have the downside. So then I look at just selling a put. Oops, let me find that. Yeah, come on back here. If I just sell a put, I make money until the stock drops the amount of the put. These are expensive puts. So at 200, at the current price, I could sell a put that is pretty much at the money. It's a dollar cheaper. So as long as the stock goes up, I put away $17.35. So my profit on one position or 10 shares is going to be on 100 shares, $1,735. So I've capped my profit. No matter how high it goes, I can't make any more money. But my risk is all the way to zero. So I hate this trade because my gain is limited, my risk is big. So why would anybody sell puts? Well, you don't sell put at the money. I might rather look at my spread and say, let's sell a 225 put, way out of the money. All right, now I'm only going to collect $11, but the stock's got to fall all the way to 210 by August 18th, 213 for this to break even. So people who would just sell a put would likely sell a far out of the money put because they don't want to lose money. They just want to pocket the premium. And I make that whole premium until we get to 225, and then I don't go underwater until less than 213.59. So just selling a put looks like an interesting trade, but it does have a big downside risk. The further away from the money that put is, the less credit I take. So that's okay. That synthetic stock I mentioned, does this not look, let's get this to work. Let's make this as big as I can. Come on, computer. I don't know what it is with this computer. Whenever I dummy down the, all right, please work. All right, that's good. Hold on a sec. All right. So if I do a synthetic call, remember for me to buy 100 shares at 241 was going to cost me $24,000. The stock could go to zero, so my risk was $24,000. The stock could go to infinity. My upside was infinity, but it cost me $24,000 to get in. When I do this trade, which is buy and sell at $240 a call and sell a put, it costs me nothing. I get $95 back to take the trade. $95 back to take the trade. My risk is infinity. Excuse me, my risk is it goes to zero, which is the same $24,000. My maximum profits is infinity, and actually it's going to cost me $1. I won't get $1 back. It's cost me $1 per share to control 100 shares. So for $100, or in this case $95, I'm going to control 100 shares of Coherent. Now, some people would say that's too much risk, and I would say then don't take the trade, but this is the exact same chart as if you bought the stock. So here's how I can make this less risky. Let's add an option. We're going to buy in August, and let's buy that 230 put for $11. And now I'm going to look at it, and what do I see? I see the same upside, except I've got to move up because I just spent $13 on that protective put. So the stock's got to get to 253 for me to break even. So my break even here is 254.10. I am getting paid, all right? I'm getting paid, I'm paying rather $14.10, so it's costing me $1,410 for this trade. So now let's compare this trade to buying the stock. The most I can win, I can lose now, is $2,410. Where does that come from? That comes from the delta between the current price and the 230 put. The most I can make is infinity, and my cost is only $1,410. So what I've done is I've created a trade that allows me to limit my downside risk with buying the protective put, get the same upside as if I bought the stock, and I'm controlling 100 shares, not for $24,000, but for $14. And the other thing is the impact on my margin is nominal because of I'm only having this much risk. Now, let's say I don't want to pay that much money. I could give up some of my upside and I could sell a call. Let's sell it, let's say a $260 call. So now, let's see if it's going to count. All right, now a couple things have changed. I only have to pay $3.40 for this trade. My risk is $13.40 because it's much cheaper to get in, but my maximum gain is now $16.60. So I've traded less cost to get in, less risk for capping my gain. That's how I use options, and why my trade that I like is what I called my chicken shit, because I'm limiting my risk, getting into a $2,400 stock for $1,400 for 100 shares, for a $240 stock for 100 shares. I have a pretty sizable Amazon position, and that is how I accumulated it. Back to the story here. So I like Coherent a lot. Just one more thing to check on it before we go is its earnings are not to July 26th. That's important to know. I think this is a very low risk buy. It's touched the 50 multiple times. It bounces. I like it here, and I probably will take that trade tomorrow. Look at the earnings per share growth. Again, if technology sells off, I reserve the right to not take the trade. And you shouldn't take it either. You should just put it on a watch list. Quickly, specialty pharma. Omeros, I don't know anything about it. I do think they're in the cancer space. I just don't know about them. They have a pretty looking chart here. You could see Omeros is breaking out to what's probably pretty close to all-time highs, if not all-time highs. Two kahunas was your tip-off, lots of volume coming in. Something's going on with the stock. It's worth watching, but it's already very extended for my taste. Therapeutics MD, I'll pass. It's below the 200. Valiant, also below the 200. Probably a good price, but not for me. Here's an interesting chart. Fold. It's moved up quite a bit. It's getting close to extended. But this one's on my watch list. Had a kahuna on Friday. So again, I don't see a whole lot to love there outside of the first one, Omeros and maybe Amicus. I mentioned the refiners. Looking at the refiners, breaking above the 200 here, pocket pivot, kahuna, everything's green, Mobo breakout, 3.5% dividend on Phillips. Valero I liked even more. You can see the chart was in an uptrend, pulled back to the 50, broke out with a pocket pivot. Green on the bongos, 4.3% dividend. PBF Energy doesn't look so exciting. MPC also looks good. It broke out a couple weeks ago. Another pocket pivot, 2.7. So your REITs and your refiners pay dividends and don't have great charts. Speaking of not great charts and paying dividends, I think there's a theme today. And maybe with the rates falling, it's all about buying bond equivalents with big dividends. AT&T, stocks in a downtrend, but you probably want, or maybe is reversing the downtrend. I think you want to buy stocks like AT&T when they're down, not when they're up. Pays a 5% dividend. Vodafone, interesting pattern, 5.5% dividend. Just curious what any others here that I want to look at. GoGo, the crappy internet on the plane, had a nice rise, pullback. I'd like to see some momentum coming in there. So AT&T looks okay. Application software. I mean, it's hard to tell you that I've got great charts to show you, but it's really the market we've been in. Nice uptrend, pulling back to the 50, an expensive stock. Don't like the earnings per share, no dividend. Twillo's one I used to own. It's been in a downtrend forever. Break above the 50 with some momentum might be worth watching. Notice the weekly bongo's been red forever. Athena Health in the healthcare technology, breaking out to new highs. Not much in the way of earnings per share growth. Jonathan Bush is a dynamic CEO. We actually compete against them. Some earnings are July 20th. That one looks interesting. I'd rather buy it when it's cheaper, though. NetEase. So not great charts here. A couple looked interesting. Well, here's a good one. Paycom, this is one that I currently own already. A very nice pattern, lower left to upper right. Did pull back with a tech wreck down to the 50 and bounced. Mobo breakout from a squeeze and a pocket pivot on Friday. It's got some earnings coming in. I like Paycom as well. As I said, I already own it. And also down in this group, 5.9, another one that I have in my portfolio, sold off hard, is now breaking back up. I like this one. And I also like SAP's chart. And they all the same thing, big uptrends, pull back to the 50, now looking to see them move higher. This one isn't ready yet, but I'd watch it closely. Backing up, number 7, medical devices. We'll look at the first two, Medtronic and Stryker. Nice uptrend here, nice looking chart. Not a lot of earnings per share growth, pays a small dividend. Stryker, chart looks very similar, nice uptrend, pays a 1.2% dividend. I don't see anything real exciting that's going to blow up on me and go up. Large pharma, J&J, look at the first 3 or 4. J&J pays a nice dividend, about 3. Let's see, it's at 2.5% as the price moved up. It's breaking out to fresh highs, makes money but not great earnings per share growth. A defensive play in most markets. Pfizer, not nearly as strong below the 50. I'd probably take J&J first. And AbbVie is one of my favorites. I've mentioned it before. It acts like a biotech and pays a dividend of 3.6 like Big Pharma, has earnings growth, but don't be informed. It's got some pretty significant generic drug risks over the next couple of years. Integrated oils, I'll just take a look at BP. I thought this one looked interesting among others. It's above the 50, pulled back down and bounced on Friday. Weekly bond goes green, had a kahuna, pays a 6.6% dividend. And then let's just skip down and look at biotech. And I really want to point out the first two and then counter it with a couple of the others. The good news on biotech is that Celgene looks viable here. It's broke above the 50 with a pocket pivot. The weekly bond goes turn green. It's got earnings per share growth greater than its multiple. This one looks like it wants to go higher. This is a least lower a IPO. I don't know anything about it. BIVV. I think it was a spin out. I don't remember. Let's see. Oh, this came out of Abbott. I mean Baxter rather, or I believe it was Baxter or Shire spun this out. Pocket pivot, kahuna, off the 50, high close doji, Mobo breakout from a squeeze. I think that looks very interesting. This stock, Glycomimetics, has been interesting, ran up, flagging here. Is it ready to run again? It's worth watching in my book. That's the good news. The challenges are Regeneron, selling off hard here on volume. Biogen IDEC trying to make a move and continues to fail to take off. Gilead, Insight. So there's a lot to like. Tesaro's moving up again, for example, on takeout rumors. But there's a lot that have to be better for this group to turn around. Like I said, there's a tweet coming this week or an executive order. So let me kill those. What I wanted to do was go through a top-line approach, show you some of the stocks that I'm looking at, give you my sense of the market, show you the trade I'm going to take on Coherent, not the drug companies, but the technology play. I often put up the stocks I'm looking at and see if there's anything else I want to show you. So let's just put this on that combo. I'm going to go to my buy watch list. And there's Paycom at 5.9. Envision Healthcare to me was sort of a bottom fish. I know this company well. They sold off, broke above the 50 on some pocket pivots, had a couple of kahunas, still has a red bongo weekly, which is bothersome. The earnings don't look great, but the pattern of a gap up, sideways, pull back to support, look at the group strength. That's one I want to be watching this week. In the REIT space and healthcare, this is Welltower. Nice lower left, upper right, pocket pivots galore, pays a 4.6% dividend. Gaming and leisure is a REIT in the obviously gaming and leisure space. Nice uptrend, pull back. If a move above the PSAR dot, out of mobile breakout screed, pocket pivot, and a kahuna, great earnings per share growth, 6.7% dividend. I think that one looks compelling. Viva has been a big leader in the high-tech space. It's pulled back to the 50. Think Coherent, think AAOI. This might be one where you put your stop a little bit below the 50 and buy a partial position. Parker Hannifin, an industrial company, sideways forever, breaking out above the 50, strong group strength, mobile breakout from a squeeze, pocket pivots and kahunas, 1.6% dividend. My only challenge there is the Bongo Weekly. We looked at several of the refiners. And not a lot of energy stocks that I liked. Every once in a while, and usually I get my face slapped, I go fishing for bottoms. No, not those kind of bottoms, but bottoms on stocks. I mean, Sanchez has come down to this level before and bounced, and then I wished I would have bought it. It's here again. Obviously it's got a pretty simple to see what the bottom of the range is. It's probably 0. Broke above the 50 with a kahuna, Mobo breakout from a squeeze. Big demand for whatever reason in the stock. Earnings aren't until August. So just out of curiosity, SN, let's look at some options on SN. I don't usually buy options on cheap stocks, but I want to look at a single option. Maybe they don't even have options. They got to have options. All right. So I could control for $1.32 with a strike price of $7 a share of stock. Now that's a huge percentage. But I could buy really for about $6,500. I could buy 50 calls and control 5,000 shares. If it's a $7 strike price and I pay $1.32, say $1.35 with commission, it's got to get to $8.35 by the third weekend in October. So I'd be risking $6,000. And I could sell it anytime. And if it runs back up to 9, I'll be able to sell it then and take profits. I might look at this, but this would purely be to capture that move back to the 200. I wouldn't expect it to break above that on the first time. But this, sometimes I will go bottom fishing, and that's why it's on my list. There's AT&T and BP. So we looked at many of these stocks. And I guess at this moment, let's just see what industries popped up for me. Application software, Adobe. And again, put this again with Coherent and some of the others. Great stock on the run up, sitting down on free parking. Historically, in sideways and in bull markets, buying stocks off of the 50 in an uptrend has made me a lot of money. I've shown you a number that are sitting there this week. So lastly, let's just look at other industries. Biotech, I showed you a couple that I thought were interesting. Some REITs, refiners, and semiconductor devices. So on that note, I think I'll say goodbye. Have a great week.